Good morning, it's Jeffrey Christian. It's Friday, the 19th of March, around 11 o'clock in New York, daylight savings time. We have been asked to talk about the relationships among interest rates and money supply and inflation and gold in the comments that have been attached to some of our recent videos. So we're going to talk about that today. Now, let's see if I can make this work. These topics are covered in greater detail with much more understanding and explanation in our Gold Yearbook. Our Gold Yearbook for 2021 will be released on Tuesday next week, March 23rd. There is a free briefing that will be available on the internet. In the email cover note to this video, there is a place to register to attend the briefing, and there should also be a place where you can click on it and buy the report. The report costs $160, and it is, all modesty aside, the definitive work on on gold. You will find a tremendous amount of information in there that you will not find elsewhere, and you'll find an unvarnished, unbiased research and analysis on the gold market, along with a lot of details. I think we've talked about it in the past. There are some interesting things that have developed in the gold market in the past year, including disgorgement of precious metals by bullion banks using ETFs for gold and silver, and the use of gold bonds and gold leasing schemes to provide Turkish lira cash liquidity to Turkish citizens by the Central Bank of Turkey. And a variety of other topics that will be covered. The Gold Yearbook briefing is next week. The briefing will talk about these issues that we've been asked to talk about: interest rates, inflation, money supply, and gold. And the report covers more of it too. Let's see if I can do this. The first thing I wanted to talk about is inflation and gold. The relationship's not what a lot of people think it is. It used to be something else, but the relationship has always been much looser than people think. Gold responds to high inflation. When you see, as you saw in the 1970s, 10, 14% inflation, anything over 7% really, you start seeing investors interested in gold. If you look at specific national economies, Argentina at one point, Turkey at another point, the United States at another point, when you see high inflation in domestic economies, you will see people buying gold as an inflation hedge. And gold does respond to that cataclysmic level of inflation. It doesn't do well with long-term, relatively low gnawing inflation. And there's a book called The Golden Constant, which no one's actually ever read, but the book, the title was chosen by the editors before they read the manuscript. The manuscript says, if you look at it, there's really, gold isn't a great inflation hedge when it comes to that long-term gnawing inflation. It's good against cataclysmic inflation, as it is good against deflation, it seems. I'll talk about deflation a little bit later. Or maybe I'll talk about it now. We're not worried about inflation, and we've noticed that most central banks, economic departments, are not particularly worried about inflation. The Fed is struggling to try to get inflation to rise to 2% on a sustained core inflation basis, and it's not really having a lot of success. I'm not sure if that's wise, but they have the biggest economic research department in the world, so they know perhaps better than I do, and perhaps better than the pundits that have never studied economics on the internet that they think that there is some. But central banks around the world, along with CPM Group, are much more concerned about deflation than they are about inflation. And that has to do with where inflation comes from. Inflation comes from two sources. One is excess money, chasing relatively fewer goods and services. And the other thing is in the real economy. Now, I'll talk about too much money in a second, and I want to end there talking about money supply and inflation, because that relationship also changed in 1982-83 in fundamental ways that some people still don't seem to have caught on. And inflation, you can see here, fell sharply in 1983 and basically has not been problematic. It's been 3%, 4%, and then it got down and now it's 2% and less than that. Inflation has not been problematic in the United States since 1983. And part of the reason is for a fundamental shift in monetary policy under Paul Volcker in 1982, 1983. And that's where money supply and interest rates come in. But part of it has to do with the real economy. You've had deregulation, globalization, computerization. People say that the United States doesn't produce anything anymore. Manufacturing output, the production of manufactured goods today is something like twice as big as it was in the 1980s. It uses more than a third fewer workers because of computerization, computer-assisted manufacturing, now computerized manufacturing, and deregulation and the destruction of unions. But you're using fewer people, but you're actually making more goods today than you ever did before. And that's not counting ketchup as a good or fast foods, the way the Reagan administration proposed. So you're still in a good situation. Now, if you look at the real economy, deregulation, globalization, computerization, you have surplus labor, surplus manufacturing capacity, surplus retail capacity, surplus commercial real estate. You've had that for some time, and it's been growing, and it's been more problematic. And economists look at that and they say these are disinflationary to deflationary pressures. And they've been offsetting some of the monetary inflationary pressures that you've been seeing, and they are much more problematic. Pandemic and the economic recession are accelerating that. Even before the pandemic, you had an acceleration coming because you were moving from computer-assisted manufacturing to computerized manufacturing, and computerized provision of services, and computerized agriculture. That was coming before 2020. 2020 and the pandemic has increased and accelerated the rate of transition. So deflationary pressures, not just disinflationary pressures, but deflationary pressures have become much more important and worrisome in reality. Inflation, as I said, the Fed is struggling to try to help create 2% inflation, and it's failing. And it's failing for those factors in the real economy. Now, money supply increases and the monetary accommodation have had an inflationary consequence. And that inflation has been in the stock market and in the bond market. Bond prices are higher and stock prices are higher because of that monetary accommodation and the fact that that money hasn't gone into the real economy, it's going into the stock market and the bond market. So that's where you've seen the inflation. You haven't seen the inflation in the broader real economy, and you probably won't. Nominal interest rates. They're rising sharply. They rose again yesterday, they're rising again today. And you have two markets. You have a shorter term market of investors who use valuation models, and they are watching nominal interest rates for the 10-year bond go from 1% to 1.7% yesterday. And they're saying this is very high, this is very rapid increase, and this is very problematic. But much more important in our minds as short-term valuation driven people is we have models and we say, what's the gold price need to be to compete with interest rates at 1%? And then when the interest rate goes to 1.3, 1.5, 1.7, what does the gold price have to be? And it's not just gold price, it's across asset classes. You see these valuation models being used. And many of them now are computerized, You don't even have somebody saying, oh, interest rates are rising, I should sell my other assets, because in order to compete with higher interest rates, those asset prices have to be lower. Nowadays, a computer does that for the guy while he's chatting with his buddies on the phone. So as the interest rates rise, these shorter term investors say, with higher interest rates, the prices of other assets, including gold, have to decline. And there's a short-term negative effect on gold prices, which we've seen over the last couple of months as those interest rates rise. There's a completely separate investment market, which are more macroeconomically and fundamentally driven people with a longer-term perspective. And they're saying, I don't understand why gold prices are weaker in the face of rising interest rates, because let's be honest, rising interest rates have only gotten up to 1.7. This is through earlier this year, end of February, and they're still very low. If you look at them on a historical basis, they're extremely low. So I don't see 1.5% interest rate on a 10-year bond as being so compelling that I'm going to sell my gold and put my money into 10-year bonds. What really matters are real interest rates. And real interest rates, this is, again, through February, real interest rates also remain negative. They're not low, they're negative. And they've been negative for some time, and they're probably going to continue to be negative for some time. So we have a situation where you say, okay, interest rates are rising and short-term valuation-driven models say gold prices should be lower as a result. But a lot of macroeconomic people say, I'm still not going to do that because of this. And if you take a look at it in a long term, I mean, I started in the business in the 1970s when we had negative real interest rates for an extended period of time, really from about late 1973 into 1980, when Paul Volcker took over the Fed in October of 1979 and changed the rules. He said, we're not going to target interest rates, we're going to target inflation. And he took up interest rates to 21%. These are quarterly prices, but if you look at nominal interest rates on an intraday basis or on a daily basis, you can see that when inflation hit 14%, Volcker had 21% interest rates. And what that did was it killed inflation. Now, in 1982, you saw a situation, well, I'll get to that when I talk about money supply. If you look at the relationship between interest rates and gold, this scatter plot tells you everything you need to know. The relationship is negative 16%, I think it says here. No, negative 0.35%, negative 16% correlation. Other measures will show you a 0% correlation between changes in real interest rates and changes in real gold prices. But you can see here, there are periods of time when, yes, rising interest rates or high interest rates correspond with lower gold prices or falling gold prices. But you can see that it's all over the board. There are times when they're both falling together. There are times when they're both rising together. There are times when gold prices are falling, but interest rates are high. And that's a relatively smaller portion of the time. And then if you disaggregate it, you say, well, what are the conditions then? What you find is that it takes real interest rates of about 3% or higher before they correspond historically over the last 50 years. And it's very funny because I was talking about this to somebody the other day. He said, well, that's history, you know, the last 50 years. Things have changed now. So of course, yeah, right. Okay. Over the last 50 years, it's taken real interest rates of 3% or higher before people say that's attractive enough that I don't think I want to own gold. I'll buy less gold and I'll buy more treasuries because I can lock in 3% interest rates. 3% real interest rates, 2% inflation, 5% nominal interest rates. I don't know anyone who thinks that U.S. Treasury is going to get to 5% on a nominal basis over the next few years or several years. I know looking at the Fed's dot points that came out earlier this week, they're looking at treasuries remaining around 0.25% for the next 2 or 3 years. So higher interest rates can have a negative effect on gold. They have a short-term effect through the valuation guys, but On a longer term basis, it takes much, much higher interest rates, and higher interest rates than most people reasonably expect to see in the near term, in the next several years, before you start seeing a negative effect on gold. Now, money supply. I keep mentioning 1982, and 1982 was a very big year because we were into a double dip recession. It was the biggest recession in the post-war period. In 1981, you started having an international sovereign debt crisis in Eastern Europe. It spread to Latin America in the first half of 1982. Mexico, Brazil, Argentina, and Chile were about to default on their government bonds. And the US government did several things. First off, Nick Brady, who was the Secretary of Treasury, created Brady bonds. He said, if you guys don't like these Latin American sovereign debt, we'll buy it. The US Treasury will buy it from you, pay for it with Brady bonds, which were US Treasury backed bonds that had an index to the Latin American economies. And we'll buy those things for you at cents on a dollar. That staved that off, and you saw a lot of those bonds ownership transfer from private investors and banks to the US Treasury. You saw a very similar situation with the Greek debt. In 2011, the ECB and its member banks could not sell bonds and use the proceeds to bail out Greece. In 2012, they got legal approval to do that, and a lot of private holders of Greek debt who had suffered mightily and were very worried in 2011 sold that debt to the ECB's member banks. In 2015, when you had the renegotiation because those bonds were coming due, it wasn't an issue because those bonds weren't held by the private sector, they were held by central banks, and the central bank said that's fine. This is not a problem for us the way it was in 2011 for that. But the other thing that happened, which was very important because it has happened repeatedly since then, is that Paul Volcker at the central bank convened central bankers from around the world in Washington, June, July of 1982. And he said, we're in trouble here. We've had 2 years of recession, the deepest recession in the post-war period. We really hammered inflation, but now we're in trouble. So let's open the sluices and pump money supply in. And you saw this massive increase in money supply. And if you look here, it's kind of hard to tell, but it was right here. It's about a 14% increase in M1 from a very low level earlier of about 5%. And over here, which is very important, MZM is broad money supply. It replaced the M3 measure. M3 went up to 36%. That's very important. You had a 14% increase in money supply, M1, narrow money supply, and that money was lent and spent so that the broad money supply rose 37%. And that got us out of the recession. Now, in June, July of 1982, gold prices were about $280 an ounce. People said, I don't need this. I can get 21% nominal interest rates from the Treasury. They saw this money supply and they panicked. Oh, this is hyperinflation. Gold in 6 months went from $280 to $500 by the end of 1982, beginning of 1983. Now, at that point, we were out of the recession. So the monetary authorities, led by the Fed and the Treasury, sopped up that excess liquidity. And you can see this massive decline was a relatively slower decline in M1, but a massive rapid decline in MZM. And the Reagan administration helped them out. They took a $58 billion budget deficit, turned it into a $325 billion budget deficit. The Treasury had to sell bonds to pay for that deficit, and the Fed was able to do that. They sopped up all of that money supply and sterilized the inflationary implications. And that became the Volcker model. You saw them do this. And this was, there are a bunch of people who gruesomely misrepresent monetary policy. And some of them clearly just don't understand it, but some of them understand it and they choose to be obstinate for ethically questionable monetary reasons. So they criticize Ben Bernanke by talking about when you get into a crisis, you throw money from a helicopter. And then when you get out of that crisis, you sop that excess liquidity up and you sterilize the inflationary implications. And what Bernanke was referring to was the policy that Volcker showed worked in 1982, 1983. And as I said earlier, and you can see from here, he killed inflation, killed the Carter administration too, by driving us into that recession. And you got to give Carter credit for hiring Paul Volcker and saying, look, you know, it's probably going to cost me the election, but we got to get rid of this inflation that's been so problematic in the 70s. We haven't had an inflation problem in the United States since that time. We've had a number of crises: 1987 stock market crash, 1991 recession, 1997 Southeast Asian currency crisis, 1997 Russian government debt default, 2001 tech boom bust and recession, 2008, 2009. And every time what they've done is they've pumped up money supply, gotten us out of the crisis, sopped up the excess liquidity, and sterilized and obviated the inflationary implications. Now that's worked several times. A couple big things to pay attention to here. 2008, 2009, you had a 20% increase in narrow supply, money supply, and a much more muted increase in broad money. Because prior to that, that money was lent and spent. But starting in that recession and that monetary accommodation period, what you saw was the money going into the stock market and the bond market and into the bank reserve levels, as opposed to being lent and spent. And as a result, you can see a much slower reduction in the excess liquidity after the 2007-2009 recession. And now this is the current monetary accommodation. And let's be honest, this thing is way off the charts. This chart, I almost was going to pull an earlier chart without 2020 in here, so you could see the dramatic increases prior to 2020. But 2020, just like our chart that we show on federal budget deficits, 2020 just blows it away and it makes everything else almost flatline. But this is the relationship between money supply and inflation. And you can see that all of this money supply may not lead to inflation. Now, we're in uncharted territories because of the size of the monetary accommodation, and things have changed over the last several years. But the plan among central bankers is that you can, in fact, obviate the inflationary implications of that. And you have a lot of real economy pressures for deflation, which are offsetting that. Because as I said, the Fed would like to see higher inflation, and it can't get it. It can't get it because the Fed doesn't manufacture inflation. It can contribute to inflation. It hasn't since the 1970s, since Paul Volcker took over the Fed. And you could possibly avoid that now. So the relationship between interest rates, inflation, money supply, and gold is a lot more complex than a lot of people would like you to believe. Interest rates can rise, and they can rise for a long time, and they can rise significantly from current levels and still not have a negative impact on gold because they are so low. Inflation probably is not nearly as problematic as some people think. I was going to grab some quotes. There's a guy who wrote a book in 1977, and you know, it's like, hey, the world's going to collapse. And I was going to try to grab a quote from his book in 1997 and put it next to a recent quote that he has, which was, hey, the world's going to collapse. Hasn't collapsed yet. It's come close, but it hasn't collapsed yet. So that's sort of the relationship between it all. We will be talking about this stuff again on Tuesday during the Gold Yearbook briefing. The Gold Yearbook has a written explanation that goes into greater detail about surplus labor, surplus manufacturing capacity, the relationship between money supply and inflation, and gold. It is a gold book. The cover email has these links to it, so you can sign up and attend the webinar, and you can buy the yearbook. Thank you. Have a good weekend. Stay warm if you're in the northeastern part of the United States. And stay happy regardless. Take care.